Hey there, it's Jesse Herrington, Heritage Home Lending. Hope all is well. Hey, we want to be your source for anything mortgage related, but today I'm going to go specifically into investment property purchases and get you thinking about some things in the future in case you ever want to look into this, of the four different factors that you need to consider and you need to look at so you can plan ahead. So what I am going to do is go over a sample transaction based upon a home here in Rapid City that costs $300,000 and show you these four different categories that we look at to look at the cash on cash return in the future, and plus to look at your overall return on the property if you were to sell it, say 10 years down the road. So let's take a look at this sample that I prepared for you. Again, it's $300,000. So the first one of those four categories that we have to consider is renting. How much are we going to be able to rent that property for? So in this scenario, we're able to rent it for $2,260. The other thing that we need to build out in our sample is how much will rent increase year over year, and then how often will that property be vacant. So I've went with a conservative figure here for future rent increase, and then I've looked up the average vacancy factor for South Dakota and come up with this 5.8 percent factor. So that's our first category that we consider is rent. The next thing that we need to do is look at specific to the property some details. So what's the price? $300,000. What's the taxes? What's the homeowner's insurance? We need to put in some figures here for how much is property tax going to increase year over year. We need to plan for maintenance. We need to plan for the management fee if a property manager is going to be handling that for you. And then we also need to plan for the future down the road when you sell the property. If you sell it with a real estate agent and they charge you a percentage of the sales price to sell it, it's customarily around 6%. We need to factor that into our equation. So category number two, property, we've got that accounted for. And then number three, we have to look at the loan that we're using. So most people tend to go with a conventional 30-year fixed rate loan on investment properties. So we've used that for our sample. We take the amount of money that you're borrowing. In this instance, putting down 25%. On investment property, you do have to put at least 20% down. You get a better rate if you do 25% down. So I've assumed that in this scenario. Then we have the loan type, fixed rate, the interest rate, the closing cost. Just a little note about that. That's a combo of the closing costs plus a partial discount point to get the 6.875 rate. So I have those things accounted for. And then the last category that we need to take into account is, we're going to call it home ownership. So how many years are we going to own this home? And then should we use historical appreciation or forecasted appreciation? For my scenario, I'm just going to use historical appreciation. Now, the appreciation factors over the last several years have been much, much higher than 3.4%, but I'm going to use a very conservative figure here. So we've looked at those four categories. Again, rent, property, loan, and then also home ownership. We got those four categories built out. And then we're going to look at the cash flow. So the monthly cash flow for year one means the property will be vacant a little bit. You can see that the $2,260 of rental income, counting the vacancy factor, drops to $2,129. And then we've got our expenses, so for our loan, our property management, our maintenance, all that stuff equals $2,160. So the first year, we're actually having a negative $31 a month in cash flow. Okay. But what happens is, you can see year one, we have summed up here. We've got this negative cash flow. Year number two, we're able to increase that rental income a little bit. So now we're going to get into the green on the cash flow. And then each year, it's just going to get a little bit better. And then we're going to go out here till year 10. Okay. So at the year 10 data point, our total cash flow over those first 10 years is $43,997, and we originally invested that $75,000 down payment plus the closing cost, and so now the cash on cash return has become 53.1%. So we've made up a good chunk of that original investment. So that's one component of our analysis. And then we also have to look at, like, if we sell this property now, it's been 10 years, how much did it appreciate using those historical figures? So if we use 3.4%, that $300,000 home is now worth $419,219. Okay. And then meanwhile, we've also paid down the loan $32,494. So this is what's left on our loan balance, $192,506. So now we're going to assume selling that property in 10 years. Okay, so here we go. So we've got the total of the rental income here, the total of the appreciation. So our gross revenue figures this, $431,399, and then we have all of our expenses. So we've got the interest, property taxes, insurance, repairs, closing costs, to buy and sell. All of those fees are totaled up here, $266,724. And so what our profit is this, $164,675. So we originally invested $75,000 into the property, and so our average annual compounded return is this, 12.3%. So those are the considerations that you want to look at when considering an investment property. Is you want to build out a scenario like this so you can figure out if it's the right decision for you. So if you're planning something like that in the future, feel free to reach out where we can get you qualified. We can go over samples like this one, or maybe you're just looking to buy a different primary residence or a second home or something else, and we of course can help you with that as well. So hope this has been helpful. Hope all is well, and have a great day. Take care.